In 2023, the IRS initiated over 1.1 million automated bank account reviews. A disproportionate share of the people flagged were over the age of 60, not criminals, not tax cheats, retirees, people who spent their whole lives doing the right thing, saving carefully, paying their taxes, following the rules. And here's what makes this dangerous. 3 of the triggers that caused those reviews are things you are probably doing right now. The first one, a perfectly legal cash withdrawal can cause a federal report to be filed on you, without your knowledge, without your consent, and without anyone at your bank telling you it happened. The second one, moving your own money between your own accounts can make you look like a money launderer to an algorithm that doesn't know your name. And the third one, I'm going to hold this one for a few minutes, because it involves something almost every retiree does before December 31st every single year. And almost nobody knows it was quietly added to a new IRS compliance checklist. When I tell you what it is, you're going to recognize yourself immediately. Here's what I also need you to know. Your bank is legally required to file that report on you, and legally prohibited from telling you they did it. That's not speculation. That's the Bank Secrecy Act. In the next 18 minutes, I'm going to walk you through all 7 flagged behaviors. I'm going to show you a real case. A retired school librarian from Ohio who lost access to $34,000 for 11 months without being charged with a single crime. I'll explain the exact IRS and FinCEN rules behind all of this, and I'll give you 4 specific moves you can make, starting this week, that completely sidestep these triggers. Stay with me. This is the video your bank doesn't want you to watch. My name is Marcus Graves. I'm an enrolled agent, federally licensed by the U.S. Treasury Department to represent taxpayers directly before the IRS. Not a financial advisor, not a CPA, an enrolled agent, which means when something goes wrong between a taxpayer and the federal government, I'm the one in the room. I've spent over a decade reviewing IRS correspondence, bank transcripts, and compliance files. I know exactly how IRS examiners are trained to read a bank statement, and I know which patterns they've been specifically directed to watch for in the last 18 months. Here's something your bank will never say out loud. They earn fee revenue on every account you hold. Your financial advisor earns a commission or management fee on every dollar you keep with them. Neither one has a financial incentive to tell you that your normal, innocent behavior might be generating a compliance file with your name on it. What I'm sharing today comes directly from IRS Publication 1544, FinCEN guidance under the Bank Secrecy Act, and real case documentation. This is not opinion. This is the rulebook, and today you're going to read it. I want to tell you about a client I'll call Diane. Diane is 68 years old, retired school librarian, Dayton, Ohio. She and her husband spent 35 years saving carefully, not wealthy, just responsible. When her husband passed away in the fall of 2022, she inherited their full joint account balance, about $210,000 between checking and savings at their local community bank. Diane wanted to pay off the house. She wanted cash accessible. So over 6 weeks, she made a series of withdrawals. $9,500 one week, $8,200 the next, $9,800 the week after that. Completely legal, completely understandable. She was a widow managing her finances alone for the first time in decades. What Diane didn't know is that those withdrawals, all just under the $10,000 federal reporting threshold, matched a specific pattern that the IRS and the Financial Crimes Enforcement Network call structuring. The algorithm doesn't ask whether you intended to do anything wrong. It sees the pattern, it files the report, and within 90 days, Diane received a letter informing her that her account activity was under federal review. Her bank froze $34,000 of her own money, pending investigation. Diane had no tax debt, no criminal record. She had done nothing wrong, and she spent the next 11 months trying to get her own money back while paying her bills from a shrinking secondary account. I'll tell you what happened to Diane at the end of this video, but first, you need to understand exactly how this system works, so it never happens to you. The law at the center of all of this is the Bank Secrecy Act of 1970. Codified at 31 U.S.C. Section 5311, it requires every U.S. financial institution to file a currency transaction report, a CTR, for any cash transaction over $10,000. Most people have heard of that rule. Here's the one that catches retirees off guard. There's a second report called a Suspicious Activity Report, a SAR. A SAR is filed not because of a specific dollar amount, but because of a behavioral pattern. Banks are required under FinCEN regulations to file a SAR anytime a transaction appears to be structured to avoid reporting. There is no minimum dollar amount, there is no warning, and there is no notification to you that it was filed. Ever. Here are the 7 behaviors that are triggering those reports right now. Number 1. Sub $10,000 cash withdrawals in a short window. This is exactly what Diane did. Multiple cash withdrawals, each kept just under $10,000, made within days or weeks of each other. Under FinCEN Regulation 31, CFR Section 1020.315. This is the legal definition of structuring. It is illegal even if every dollar you withdrew was legitimately yours. A 71-year-old retiree in Florida withdraws $9,800 on Monday and $9,600 the following Friday to pay a contractor. Both transactions are flagged. A SAR is filed. He has no idea. Number 2. Sudden large deposits from unusual sources. Bank compliance systems compare every deposit you make against your 90-day average. A sudden spike, even from a completely legitimate source like an inheritance, a home sale, or an insurance payout, looks anomalous to the algorithm. A 63-year-old retiree in Georgia receives a $78,000 life insurance payout. She deposits it as a lump sum. Without prior documentation on file, this generates an automated review. Number 3. Frequent transfers between your own accounts. Moving money between your own checking, savings, and money market accounts at an unusual rate can mimic a money laundering behavior called layering, where funds are moved repeatedly to obscure their origin. A 66-year-old retiree in Arizona moves funds between 3 accounts over 6 weeks while shopping for better CD rates. Her bank flags the activity internally. She never knows. Number 4, and this is the one I mentioned at the beginning. Taking your required minimum distribution as a cash withdrawal. Under Internal Revenue Code Section 401A9, once you turn 73, you are required to take a minimum distribution from your traditional IRA every year. That's your RMD. For a retiree with $300,000 or more in a traditional IRA, that RMD can easily exceed $10,000. If you take it as a single cash withdrawal, that's an automatic CTR. If you take it in multiple cash installments spread across weeks, that's a potential SAR. A completely mandatory, legally required transaction creates a federal compliance file. A 74-year-old retiree in Michigan takes his $14,200 RMD as a cash withdrawal in November. A CTR is automatically filed with FinCEN. He finds out 2 years later when he hires me. Number 5. Depositing gambling winnings in irregular amounts. Casinos are also required to file CTRs. If you win at a casino and deposit the cash yourself in varying amounts over multiple trips, both the casino and your bank may independently file reports. A 70-year-old retiree in Nevada wins $22,000 across 3 casino visits and deposits the cash over 4 weeks in varying amounts. 3 separate SARs are filed, 1 by the casino, 2 by the bank. Number 6. Using payment apps to receive large or regular transfers. Under the American Rescue Plan Act of 2021, the IRS lowered the 1099-K reporting threshold for Venmo, PayPal, Zelle, and Cash App to $600. If you receive rent, reimbursements, or family support through these apps, and those funds hit your bank account, you may receive unexpected tax documents. And if those deposits arrive in irregular bursts, your account may also be flagged. A 67-year-old retiree in Texas receives $4,800 in rent from a tenant via Zelle over 4 months. She receives an unexpected 1099-K in February. Her account is flagged for review. Number 7. Opening or closing multiple accounts in a short period. Opening more than 2 new accounts or closing existing ones within a 90-day window while simultaneously moving balances matches a known compliance red flag, even if you're simply chasing higher interest rates or consolidating accounts after a spouse's death. A 72-year-old widow in Virginia closes 2 accounts and opens 3 new ones across 2 banks within 6 weeks of her husband's passing. All 3 institutions generate simultaneous reviews. Here's a real documented case that proves this isn't theoretical. In 2014, Carol Hinders of Spirit Lake, Iowa, had her entire $33,000 business bank account seized by the IRS without being charged with any crime. solely based on a cash structuring pattern. The Institute for Justice litigated her case publicly. The IRS returned the money only after national press coverage. Her case is now cited in congressional testimony on IRS reform. The IRS algorithm doesn't know your story, it only knows your pattern. Here is what you do about it. Move 1. Transfer. Don't withdraw. Instead of pulling cash to pay a contractor, a family member, or a large expense, use a bank wire or ACH transfer. These create an automatic traceable paper trail that satisfies FinCEN documentation requirements and eliminates the structuring flag entirely. Ask your bank to initiate a wire or ACH. Keep the confirmation on file. Most banks offer this free for amounts over $5,000. Move 2. File a proactive source of funds letter before any large deposit. Before depositing an inheritance, a home sale payout, an insurance settlement, write a brief letter to your bank's compliance department. Identify the source, the expected amount, and the expected date. Attach the documentation, the estate letter, settlement statement, or insurance notice. Call your branch manager. Ask to speak with the BSA officer. That's the Bank Secrecy Act compliance officer. This is a standard request. Any bank will accommodate it. A bank that already has your documentation has no reason to file a SAR. You've done their job for them. Move 3. Take your RMD as a direct electronic transfer, not cash. Contact your IRA custodian, Fidelity, Vanguard, Schwab, TIAA, and request that your required minimum distribution be sent as a direct electronic transfer to your checking account. The RMD is still fully taxable, but it arrives as a wire, not cash. No cash means no CTR. No CTR means no automated flag on a transaction you're legally required to make. Log into your IRA account portal and select Distribution Method Electronic Transfer, or call your custodian directly. This takes one phone call. Move 4. Consolidate your rate shopping into one high-yield savings account. Instead of opening and closing multiple bank accounts to chase interest rates, which triggers the multi-account flag, open a single online high-yield savings account at one FDIC-insured institution. As of mid-2025, top accounts are offering between 4.5% and 5.1% APY. Marcus by Goldman Sachs, Ali Bank, and American Express National Bank are all in that range with no minimum balance requirements. Fund it with one ACH transfer from your existing bank. You get the best available rate without generating any pattern the system flags. The combination move, I call it the Retiree Shield setup. Week 1. Meet with your branch manager. Establish your customer profile. Explain your typical cash behavior. Bring 2 recent bank statements and your income sources, Social Security, pension, your RMD schedule. Week 2. Switch your RMD distribution to electronic transfer at your IRA custodian. Week 3. Open one high-yield savings account online. Fund it via ACH. Week 4. From this point forward, any large expense you'd normally pay in cash, pay by wire or ACH. Keep every confirmation. This is what financial planners do with their own money. Now you know why. Before we close, 3 groups of people watching this are at significantly higher risk than everyone else. If you've been widowed in the last 24 months, you are in the highest risk window that exists. Closing joint accounts, opening new individual accounts, receiving life insurance payouts, and starting RMDs all at once hits 4 of the 7 flagged behaviors simultaneously. Do not make any cash withdrawals over $5,000 in the 90 days following account consolidation. Meet with a BSA officer at your bank before you move a single dollar. If you've recently sold a home, ask your closing attorney to wire proceeds directly to your investment account, not to a personal checking account. If the money must land in checking first, file your source of funds letter with your bank the week before closing. If you receive regular money from family members, ask them to use bank wire or ACH, not Venmo or Zelle. For any gift over $15,000 in a calendar year, file IRS Form 709, not because you owe tax, but because it documents the transaction and protects both of you. The people who get caught aren't careless. They're ordinary. They just didn't know which window of risk they were standing in. Now, back to Diane. After 11 months, I filed a detailed source of funds reconstruction with the IRS, documenting where every dollar in those withdrawals came from, where it went, and why. The case closed. Her $34,000 was released in full. No penalties, no charges, no crime, because there wasn't one. The IRS had a pattern. We gave them a story. The story won. Diane used part of that money to pay off her car, something she'd been waiting to do for over a year. She bought a small used piano. She told me she hadn't played in years, but she needed something to do with her hands while all of this was going on. She said something I think about every time I make one of these videos. I did everything right my whole life. I just didn't know the rules had changed. Now I do. One number. That's all I want you to remember. $9,999. That number has quietly trapped more retirees in the American banking system than any other. Don't treat it as a safe zone. Treat it as a warning sign. Your bank will not tell you this. Your financial advisor may not know it. The IRS will not warn you in advance. You watched this video, which means you now know more about this specific risk than most people with twice your savings. I've put together a free one-page checklist, all 7 flagged behaviors, the 4 protective moves, and the 3 special situations, in plain English, 1 page, no jargon. And if you have someone in your life over 60, a parent, a sibling, a neighbor, a friend, please share this video with them today. Not because it's a good video, because this is information they deserve to have before something happens, not after. One share could save someone you love 11 months of fear.